So let's say that somebody does the syndication,
Mm-hmm.
and let's say they get $100,000 in deduction, and let's say they make $100,000 on a flip. I know those are different classifications. One of them's active, and it sounds like one of them is passive. Does
Mm-hmm.
that matter at all as long as they're a real estate professional, or is that kind of like would that be allowable? Would that help as long as you had that depreciation? That depreciation would still help you.
Yeah. So the key in that example is, do they qualify for real
That's,
estate professional status? If they do, then that's a perfect scenario. $100,000 flip, $100,000 loss. Those two offset each other. On paper, in terms of taxation, you made $0 and you can't tax zero. But in real life, you got $100K sitting in your bank account to go out and do it all over again. And that's wealth building right there.
yeah, because it creates that snowball effect where now you've saved 100, now you've got $100,000, you invest it again, then again, and then again, and then it almost starts to spiral. Now, the last thing that I wanted to touch on is just changes. So here's one of the things as well too. Like if you tax plan today, that
Mm-hmm.
might be different from 6 months from now. That might be different from a year from now. It might be different from 2 years from now. This is not like a one-time type of thing. This
Yeah.
is something that's ongoing, and meaning like I've got a great relationship with a loan officer. Obviously, she helps me and kind of tells me how things run. I would say that an equal important relationship would be with a tax consultant, somebody that you can run things by and say, hey, look, what about this? What about that? Would this fly? Would this not fly? What are some of the changes that are being proposed right now and that could potentially happen that could basically change the entire dynamic? I would say because there's a lot of different changes that are potentially there's talks about a lot of changes. Can you elaborate on some of those and how that would impact? And then if those went away, is there any other solutions for people to still benefit?
Yeah, yeah, absolutely. I tell you, a few that are being discussed heavily in the real estate space, and then I'll talk about some broader ones. Everyone's concerned about the 1031 exchange and what's
Mm-hmm.
going to happen. And for those that aren't familiar with it, the 1031 exchange basically says, hey, I have a property and I'm going to sell it. And as long as I agree to buy another property or properties of equal or greater value, I get to not pay taxes on the one that I just sold. So it's almost like I get to trade up without any tax implications.
Yeah.
What they're discussing right now, and a few different iterations of this proposal are on the table, is for anyone who has gains, capital gains in excess of $500,000, which are typically going to come from larger single family units or multifamily or commercial units, right? But anyone who sells those kinds of properties and their gain is higher than $500,000, you're going to be limited in how you can use that 1031 exchange. Either you can only use it to offset partial amounts of the gain, or you just can't use the darn thing at all, depending on how large your gain is.
Yeah.
And that's going to impact the transactions that we see happening. Some people are going to decide to hold on to property because they don't want to pay the large tax, or some people are going to bite the bullet and just have to pay a pretty sizable capital gain tax. So here's the thing that I say about that. One, all speculation right now. We have assumptions on what we think reasonably will pass and what won't. But what if that does, worst case scenario, that exact iteration goes through? It is going to just expose some of the alternative things that we've already been doing from a tax planning perspective. With gains that large, there are tons of different vehicles you could look at. The opportunity zones become a bit more attractive because they allowed you to shield some gain, and they have a tax-free component at the end. We can get into that. There's the deferred sales trust, which basically allows you to instead of, so if you and I were going to do a transaction and we have a price that we decided on, I'm gonna go and form this deferred sales trust. I'm gonna sell the property to the trust for, let's call it $500,000, right? The trust isn't going to give me any money right away. So if I haven't received money, there's no gain to recognize. It's then right at closing going to turn around and sell that property to you. So now you as the buyer got your end property. The trust doesn't have any capital gains implications because it bought it from me for $500,000 and sold it to you for $500,000. So it nets out to zero. And when I set this trust up, I decided on a specific payment schedule that I'm going to receive funds in whatever amount. That could be 100,000 a year for 5 years, or whatever type of iteration that is inside of there. So now I only recognize a gain on the amount that I receive in a given year. Instead of paying taxes on $500,000 today, only pay taxes on 100,000. So that's a smaller tax bill. And my other four gets to stay inside of the trust and start to do other things to earn more appreciation and more value. So it's a great way to continue to invest and have gains, but pay limited capital gains on the transaction we just did. So opportunity zones, deferred sales trust. There's also the Delaware statutory trust. That's an option. And I can go on and on. The point here is there are going to be alternatives to the 1031, and it's really going to impact those that are doing larger transactions. For everyone else, it's kind of business as usual. So not a lot of panic there. We are hearing about, actually, let me pause there because that was a lot. Any specific questions on any of that?